Hello, welcome to our web-based seminar on the Securing a Strong Retirement Act of 2021. I'm Tony Marlette Jr., advisor at Brookside Tax and Financial Group. Today we're going to be talking about the legislation that was signed into law at the beginning of 2023. Before we get into any of this, there were over 4,000 pages of legislation that make up this act. So as you may have guessed, we did not go through each and every one of those, did not go through each and every one of the exceptions. For anything that pertains to your personal situation, as always, we recommend you reach out to your financial or your tax professional to get clarity. Of course, if you work with us, you can reach out to us through any of the methods on your screen. And you can always click, comment, and subscribe on our YouTube channel and our Facebook page as well. So even though this is the Securing a Strong Retirement Act of 2021, again, it's effective beginning of 2023, and it piggybacks off of the existing Secure Act, which was signed into law in 2020 by the Trump administration. And the goal of this act is to continue to advocate for providing American workers with a strong financial future, aka helping American workers save for retirement. This was a large bipartisan effort, and it received a good amount of bipartisan support, overwhelming bipartisan support. So this is not a one-sided Democrat or Republican bill. This was bipartisan, and it was worked on by the House of Representatives Ways and Means Committee, comprised of representatives from both sides of the aisle. It was signed into law at the beginning of 2023 by the Biden administration. So let's take a look at some of the details here. The goals of this legislation are to continue to allow workers to save more for retirement, also to help student loan borrowers by allowing employers to make retirement contributions to loan payments made, and supports the use of annuities for lifetime income. So we'll go into detail on each one of those. When we talk about increasing retirement savings, a large part of the reason for the urgency on this is because of the warnings that even the Social Security Administration at this point has put on their websites that benefits may be reduced for those claiming on or after the year 2035. That's going to affect a lot of people. So they're starting to put a little bit more of the initiative on employees to save with some help from the employers, as opposed to, say, the old days where everybody had a pension and the employer took care of all the contributions. It's no longer the case. It hasn't been like that for about the last 3 decades or so. But with the original Secure Act and the one that we're affectionately calling Secure Act 2.0, this is an employer and an employee commitment. So when new employees are becoming eligible for 401ks, 403bs, and simple IRAs, if they do not make any election to be enrolled in these plans, they're going to be automatically enrolled. And they're going to be increased automatically each year until you get to a maximum of 10%. So what that means is if you started a new employer and you make no election on a 401k or a 403b contribution, they're automatically going to enroll you. And that's to encourage you to save for your own retirement. Now, these are for plans that are set up at the beginning of 2023 and going forward. So they're for new plans. They're not retroactive for any existing plans, but a lot of existing plans have auto enrollment anyway. Employees or workers can opt out of auto enrollment, but you have to be proactive in doing so. In some cases, it could be a phone call. It might have to be a letter with a signature. I've spent a large part of my career on the 401k side of things. Sometimes they make it difficult for you to unenroll from the 401k, and they make it even more difficult to get your contributions out of the plan if they've already been put in. So you want to be proactive if you do not want to contribute, although really anybody should be contributing. If you're eligible to contribute to a 401k or 403b, unless you have extenuating circumstances, you really should be contributing, especially with the weakening of the Social Security system and with employers providing benefits like profit sharing and match as well. They did this, the Ways and Means Committee, based on statistical data that does support that auto enrollment helps more people save for retirement. It's probably not too hard to imagine why that would be. Some other things that are along the retirement savings line. This is a tax credit known as a saver's credit. It's not a deduction, but it's no longer tiered, and it's essentially all or nothing. So the saver's credit allows somebody who's saving for retirement to not only get a tax deduction on their retirement contributions. Again, remember, most retirement contributions are tax deductible. This takes it a step further for people who qualify and gives them a credit on their taxes. So if you have a debit and you owe the IRS some money, a deduction, remember, just reduces your income for tax purposes. This credit is going to allow you to wipe out a part of that debt that you may potentially owe to the IRS. So the saver's credit is not new, but it's less complex now. It used to be tiered, where if you made a certain amount, there was phase outs and you might have only received a 10 or 25% credit. Now it's 50% credit if you qualify. And if you do not qualify, you do not qualify. So when we say all or nothing, that's what we're referring to. In 403Bs, you're now allowed to invest in collective investment trusts, which are essentially mutual funds that are a little bit more efficiently managed, and they're a little bit more transparent in nature. Tax deferrals also allowed for employees who are employed by S corps who have company stock to sell some of that stock back to an existing ESOP plan. Tax deferrals allowed for that. We don't see too much of those, but that is a change in here as well. Multiple employer plans, something that is usually a little more common amongst small employers, can now band together to get benefits of reduced costs, more effective asset management. And again, we usually see that with smaller employers. One of the bigger changes here is the IRA catch-up contribution. So every year, the IRS will set a maximum amount that a retirement saver can contribute to an IRA, or an individual retirement arrangement. Sometimes there's changes, and in some years there is not. So for 2023, for example, the maximum IRA or Roth IRA contribution is $6,500 for those under the age of 50. There's usually a catch-up component where those 50 and over are able to contribute an extra $1,000. Well, the catch-up component from 2024 and on is going to be indexed to inflation. So again, this is not effective for 2023. The maximum IRA contribution for 2023 is still $6,500 with a $1,000 catch-up for those 50 and over. However, starting in 2024, whatever the IRS puts the maximum at for IRA contributions, the catch-up is going to be indexed to inflation. So it's probably going to be smaller than $1,000. It's going to be a percentage based on the maximum, which is also going to be tied to inflation. Again, that change does not take effect until 2024. So there's been some changes to student loans as well. Now, these changes do not have anything to do with the student loan bills that are kind of going back and forth and the orders that are going back and forth right now. These have already been approved. They're part of the legislation, and they have to do with student loans in conjunction with retirement accounts. So again, this does not have anything to do with canceling out student debt or anything like that. Those things are still being tossed around. But what this Secure Act 2.0 calls for in regards to student loans is payments for student loans made by an employee can be treated as an elective deferral. What that means is this: employers have the ability to match student loan payments by contributing the corresponding amount to a 401k, a 403b, or a 457 plan. The idea is workers who may be new to an employer or are fresh out of college or post-secondary may be preoccupied with paying down their student loan debt and limited in their ability to save for retirement. What this allows them to do is continue to pay down those student loans. And if their employer offers a match or a profit sharing to a 401k, 403b, or 457, the employer can make a corresponding contribution to the retirement account. So for example, if I'm a new employee and my company offers this, I might say, you know what, I would really like to save for retirement right now. Unfortunately, I'm bogged down with student loans. I'm not able to do that. Would you, as the employer, be able to or be willing to, if I make $300 a month in student loan payments, could you put $300 a month into my retirement? Now, again, it doesn't mandate that the employer does this. It gives them the option to do so. So again, helping people save for retirement, and in this case, without even having to contribute to a 401k or a 457 or a 403b by the employee. To receive a match or a profit sharing, remember, in almost all circumstances, you have to contribute to the retirement plan. This law is saying, hey, you don't have to do that if you have an extenuating circumstance like you're contributing to a student loan, you're trying to get student debt paid down. Can't help but ignore the tight labor market that we currently find ourselves in. This can act as a sweetener by companies too, to reach out to an employee to differentiate themselves or a potential employee and say, hey, if you come work for us, we can help you not only save for retirement, but also not have that as negatively affect your student loan debt. Obviously, if you're contributing to the 401k and collecting the match, your 401k or your retirement plan balance is going to build up more quickly. But in the event that you are paying down student debt, ordinarily you wouldn't get the advantage. Here they're saying pay down your student debt and the employer can still contribute to your retirement plan. So that's a big change there. We talked about preserving income. There's some required minimum distribution changes, or RMD, that have been affected as well. So remember, required minimum distribution is mandatory for any retirement account funded with pre-tax money. The RMD age used to be 70 and a half. The original Secure Act, after it was not updated for decades, the original Secure Act updated the RMD age to 72. And now, just a couple of short years later, the Secure Act 2.0 has made RMD age for 2023 73, with the goal by 2032 of being age 75. So the RMD age has been increased. People's life expectancies are increasing, and people are deferring taxes for longer. The whole concept behind RMD is that people do not defer taxes through generations on retirement accounts. If you don't ever use the money, you pass it along to your beneficiaries. The IRS says, no, we want tax money based on your lifetime. A big change here is Roth 401ks. Now, a Roth IRA is not subject to RMDs because it's comprised of post-tax money. Roth 401ks, however, have always been mandatory to take RMDs from. That's not going to be the case starting in 2024. So a big differentiator between a Roth 401k and a Roth IRA has always been a required minimum distribution from the 401k. Well, why not just move it over to my Roth IRA where I do not have to take required minimums? So starting in 2024, there will be no RMDs from Roth 401ks, and that puts it more in line with laws from Roth IRAs, which say no RMDs on Roth money. There's also going to be no further RMDs required on lifetime annuities. So a lifetime annuity is essentially a pension. It's basically a pension style payment that agrees to pay you and or your spouse for the rest of your life. So a lot of times, we don't see it too often, but sometimes if somebody's taking a lifetime payment on an annuity, on an IRA, and their lifetime payment for the year is less than what their required minimum distribution is, they have to take out further money. So what this legislation says is there's no further RMDs required if you're taking out a life annuity. A couple of other changes for RMDs that are pretty big. There's no RMDs required on balances of $100,000 or less if you are age 75. Now, remember, any RMD is going to be taken from an account where there's pre-tax money. Now, this is across all of your retirement accounts. So each account has to have an RMD accounted for. You can take them from one account and you can aggregate your RMDs from one account if you choose to, but each account has to be calculated. Now, what this legislation says is if you have a total of $100,000, under $100,000 the year before you turn 75, you do not need to take further RMDs from that money. This is not $100,000 per account. So for example, if you have 10 retirement accounts that all need RMDs and they're valued at $50,000 each, you have $500,000 saved for retirement. You are going to need to take RMDs on that money. What this is saying is if you have $100,000 aggregated under that amount, saved for retirement, you do not have to take RMDs if you're 75. In the rare circumstance that we see people miss their required minimum distributions, there's a penalty. The penalty has always been 50% of the amount that should have been removed from the account. Well, they're reducing that. They call it an excise tax, but it's a penalty. They're reducing the penalty from 50% down to 25%. And if you resolve it in a timely manner, it can be reduced down to 10%. So there's some big changes with required minimum distributions that they've made with this legislation. So some other things that have been included, ETFs or exchange traded funds are now allowed in variable annuities. There's a recovery of a retirement plan, accidental overpayments here, that basically says if an employer overpays accidentally into somebody's retirement account, there's a limited time and an amount for them to collect the mistakes that they've made. So the way this works is, say if I'm a retiree and I retire at 70, When I'm 75, I've been taking withdrawals from my retirement accounts for 5 years now. When I'm 75, my company or my former company reaches out and says, "Hey, guess what? We over contributed a match or a profit sharing to your account. We need to collect this back plus earnings." That can catch some retirees off guard. So what this legislation is saying is if there's any accidental overpayments, companies have a limited time in which they can recoup that and a limited amount in which they can do so. Performance benchmarks are also going to be updated. There's target date funds and allocation funds now within retirement plans that have become very common, and these are often not benchmarked properly. Remember, a benchmark is always corresponding to an index that is appropriate with the investment in the account. So there's separate comparisons now for allocation funds and target funds to be made to a proper index. So for example, if you're in a target-based fund and it's say the target year is 2040, well, that might be a relatively balanced fund. Maybe it's 60% in the market, 40% follows the bond index. So say 60-40 stock bond. It doesn't really do anybody any good if the fund is compared to the S&P 500, which is 100% stocks, or to the Barclays Aggregate Bond Index, which is 100% bonds. So what they're going to do now is make indexes or combine indexes to where there's an appropriate comparison for what to expect when it comes to performance. A retirement lost and found has also been created online. And this is maybe more common than you would think. Sometimes people lose track of their 401ks if it's with a former employer. The employers change record keepers maybe a few times throughout the years, and an employee or former employee is not able to track down their retirement balance. Same can be said for employers. Maybe a former employee has moved a bunch of times and has not thought to update their former employer with their address. There's now going to be an online national lost and found for employers and employees based on information that the employee originally contributed to the employer, that the employer then passed on to the Treasury. So this is a big benefit for employers and employees. You can imagine, even if you have a few $1,000s left in a retirement account, you're going to want that money, and it can be very difficult to track down. The last thing that we'll go over here is the charitable distributions from an IRA. These are allowed to be done in place of, the original thought was in place of your required minimum distribution, but these are tax-free withdrawals that can be taken from an IRA and that can be counted towards a required minimum distribution if you meet the age requirements, and it's tax-free. So the difference is you don't pay any taxes on these if they're done properly. The minimum age to do this is still 70 and a half. So it's not commensurate with required minimum distribution age anymore. Just an example, if you're 70 and a half years old and you want to take a withdrawal from your IRA and give the money to charity, you can still do so, and it's tax-free up to $130,000. The big thing that you have to watch out for on this is that the money has to go directly from your IRA to the charity. It cannot take any middle step. So for example, if I'm 70 and a half and I want to take money from my IRA to give to a charitable organization, I cannot take the money from my IRA, put it in my bank account, and then send the money to the charity. It has to be done directly from the IRA to the charity, and it will be tax-free up to $130,000. That can now include 401ks and all qualified plans. If you're going to do this, obviously we do taxes here. We've seen people try to do this and we've seen mistakes made. If you're going to do this, make sure you involve a financial and a tax professional, and make sure you involve the charitable organization as well. Again, I can't stress it enough. It's got to go from your IRA directly to the other institution. So that concludes our webinar today on the Secure Act 2.0. Obviously, there's a lot of changes. These are all designed to, again, help people save for retirement, to put more of the focus on them saving for retirement and being proactive versus relying on Social Security. Also want to mention it again, if you have any questions on your personal situation, be sure to reach out to your financial professional and your tax professional as well. We would obviously like to hear from you if you have questions on us, or if you'd like us to review your financial situation, we can certainly do so. Contact us. You can visit us online. From all of us at Brookside, we thank you and we look forward to working with you.